The Big Short investor Michael Burry just warned. U.S. faces a multi-year extended recession, confirmed. Michael Burry has sounded the recession alarm, warning the U.S. economic downturn will probably last several years, as he sees no way to end it early. What strategy will pull us out of this real recession? He said in a now deleted tweet, what forces could pull us so? There are none. So we are really looking at a multi-year extended recession. As for right now, investors have been conditioned to expect a Santa Claus rally in the stock market. Heading into year end as trading volumes decline, news flows dwindle, and positive psychology permeates among retail investors. But that may not be the case this year. We do have huge momentum going in both stock and bond markets. While positive seasonals definitely boost the prospect of further gains, they're outweighed by the fundamentals. And right now, three bearish fundamental factors are dominating the markets and increase the likelihood that the typical Santa Claus rally stumbles this year. What are these three bearish fundamental factors that could end this rally next week? Why is Michael Burry concerned over this unprecedented extended recession we are facing next year? Is this financial storm unavoidable, even though we already know that it will come next year to the US? I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get it into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? The investor of The Big Short fame seems to be suggesting the Federal Reserve and U.S. government have few good options to shore up growth. He has previously accused policymakers of fueling inflation by flooding the economy with money during the lockdown, and warned that could make it tougher and more expensive to stimulate growth in the future, especially if doing so would fuel price increases. Burry has been predicting a recession for a while. In June, he noted Americans faced with surging prices and higher interest rates are saving less, borrowing more, and posed to virtually exhaust their savings by Christmas. Those trends threaten to hammer consumer spending, erode corporate profits, and spark an economic downturn, he said. The Scion Asset Management founder also noted in his latest tweet that other commentators are forecasting a mild, short-lived recession, not a deep and protracted one. Who is predicting this? He said, there are none. At least one expert took issue with Burry's claim that he's the only one bracing for a prolonged downturn. Some of us have been predicting a long and severe recession and made a detailed case for why we are headed towards a great stagflationary debt crisis. NYU Stern economist Nouriel Roubini tweeted to Burry on Wednesday. Burry shot to fame after his billion-dollar bet against the mid-2000s. Housing bubble was immortalized in the book and the movie The Big Short. He's also known for investing in GameStop before it became a meme stock, betting against Elon Musk's Tesla and Cathie Wood's ARK Innovation Fund last year, and issuing dire warnings about market bubbles and crashes. Number 1, equity performance looks overdone. Stocks have already seen big gains since their mid-October low, with the S&P 500 rallying 13% and up 10% so far in the fourth quarter. But those gains are double the median fourth quarter rally of 5.5% and the average fourth quarter rally of 4.3%. Number 2, recession generally implies lower risk assets and higher volatility. As yield curves turn inverted, the writing is on the wall. An economic recession is imminent. That's been my base case since the summer, when this channel was started. And the effects of the economy slow walking into a recession means investor sentiment is likely to plummet. It is important to note that as the economy deteriorates into a recession, adverse sentiment kicks in and things tend to become nonlinear, accelerating the slowdown. Correspondingly, volatility tends to rise from half a year before the recession begins, spiking at the start of the recession. Number 3, there is a lot of event risk into year end, such as Blackstone's $125 billion real estate fund to limit investors who are trying to withdraw their money out. This sounds like what just happened to all crypto brokers. First, they told their investors they can't withdraw. A couple weeks later, they are filing for bankruptcy protection. We all know ever since the interest rates went up, real estate sector's money are drying up. Inventory up 53% year over year. New listing down 17%, as sellers are pulling properties off of the market at record pace. That's Blackstone. We just learned that Florida will pull $2 billion of assets from BlackRock. Louisiana and Missouri have pulled a combined $1.3 billion from BlackRock this year. That probably could increase some selling pressure. We know investors who owned 60-40 portfolio have been crushed by the volatile markets of 2022. Those who are licking their wounds after incurring losses might use tax loss harvesting by year end. Altogether, the heightened risk for the economy and volatility means that while the end of the year tends to be positive for the stock market based on seasonals, there's high likelihood that bearish fundamentals could dominate and lead to a fizzled out rally. As for the certainty of this recession coming next year, can we avoid this financial storm at all? Based on what we know so far, from the Psalm rule, the Fed has never achieved a soft landing when it has had to push up unemployment significantly. The rule is if the unemployment rate rises from its 3-month moving average by 0.5% or more within a year, then the economy is entering a recession. Fed Williams projects the unemployment rate could rise to 4.5% to 5% by the end of 2023 from today's 3.7%. It only needs 0.5% rise to be called a recession. 3.7 plus 0.5 is equal to 4.2%. So based on Williams' projection, recession is confirmed. Right now, based on the unemployment claims today, we are at the flatten out stage. The moving average has not turned up. Once it turned up, we are into a recession. From University of Michigan Consumer Sentiment Chart, right now, we really don't have the sentiment improved look on the chart. Still very depressing look. The bond market's most powerful recession indicators is finally flashing red. 3-month and 10-year inverted. Last 3 times this happened was at 1973, 2000, and 2006. S&P 500 lost additionally 45%. If economy goes into a recession, it's fair to say that earnings per share of S&P 500 will take a hit, assuming earnings will be flat next year at $220, and the market remains at historic 17 times PE multiple forward earning. The value of the S&P 500 will be at 3,740. That's 200 points lower than S&P 500 sits today, which is 4,071. Next year, if the earnings dropped by 10% because of recession, $220 goes down to $198. PE multiple goes down to 15 because of recession. 15 times 198 is 2,970 points on S&P 500. Average recession lasts about 10 months. But Michael Burry said it might be an extended multi-year recession. We could be getting a worse end of the stick. S&P 500 could go to 2,700 or even 2,500. Based on the Fed's unemployment rate projection and most inverted yield curves from the bond market. Even 3-month and 2-year yield are inverted. Yes, 3-month get higher yield today than 2-year or 20 years. All these would confirm that the recession is unavoidable in 2023. Okay, now I'm going to show you my client Lee Vincent's book, The 3 Most Important Influencers You Need to Meet. I did write the foreword in this book. Such an amazing book. And my client Teddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel. Such an awesome book. Teddy Eazzy is such a good boy for being my client. Teddy Eazzy is one of my Patreons. Become my Patreon today. And this is my very first book, Treasures Within Our Heart. You are such a good boy for watching my video right till the end. Bye.